Apple reportedly cancels plans to build an electric car. Apple will wind down its team working on electric cars, according to Bloomberg. The news signals Apple will cease its secretive effort to build a car to rival Tesla. Reports about Apple's ambition started many years ago, pretty much about a decade ago. Apple will wind down its team working on electric cars called Special Projects Group, according to Bloomberg. The news signals that Apple will cease its secretive effort to build a car to rival Tesla. The program employed thousands of employees, but never fit with Apple's core business of electronics and online services, and it raised questions about what companies Apple would tap to manufacture a car. Because supposedly, Apple was going to be the tech behind these cars, and then they were going to partner with a manufacturer to actually build the car. So it wasn't like a Tesla situation where Tesla creates a technology and builds the cars as well. Reports of Apple's ambition to build a car first surfaced in 2014 after the company recruited automotive engineers and other talent from car companies. There were few public indications of the company's plans, but Apple operated a program where autonomous Apple-owned cars equipped with sensors and piloted by safety drivers drove around the San Francisco Bay Area. The department had several reorganizations over the years, including layoffs in 2019, when employees were moved to different parts of the company. Some Apple employees in the company's car division may move to generative artificial intelligence, things like that. The company has obviously their project out there called CarPlay, right? That's a software that's in a lot of cars out there right now, right? This is something that obviously cost cutting for Apple. Some people might look at this as a positive for Apple specific. Now, I think this is really good news for Tesla. And let me explain why. As a Tesla shareholder, I was never that scared of Apple potentially competing with Tesla. But the reason I think this is so massive, folks, is this shows that Apple couldn't do it. Some people are reading this as, the EV market is too hard. Well, or Apple doesn't want to compete in a low margin, tough business. Guess what? Apple competes in almost all their businesses are low margin, very competitive businesses, except for Apple, right? The cell phone industry is cutthroat. It's extremely low margin, but not for Apple. They're able to make big margins, right? If you look at every competitor they compete with, the tablet business for Apple is very high margin. Ask their competitors if it's a high margin business. No, it's brutally competitive. The laptop business, very profitable for Apple, but ask their competitors if it's profitable for them. So what I believe happened here is Apple looked at this and they said, we're not going to be able to be high margin here. Doesn't matter what we do. Our tech is not going to be advanced enough to keep up with a company like Tesla and their engineers. And on top of that, we're not going to be able to make the money we think we can make in this industry, right? And so Tim Cook looks at this and he says, we can't do it. And this is despite them spending who knows how much, maybe ungodly amounts of money on this over the last, you can call it roughly decade, right? This, in my opinion, is also a huge failure of Tim Cook not to be able to be a success here, right? We know if there's one big knock against Tim Cook, it's the fact that he's running off the fumes of Steve Jobs and Johnny Ive. The whole company that's built today, and the whole reason this company is a success is because of Johnny Ive and Steve Jobs, those two gentlemen. And this is another example of a Tim Cook failed project. Now, if they fail in VR and AR with that Apple Vision Pro, then it's just, that's going to be very detrimental to Apple stock long term, right? Because right now, they still, as long as they can sell, tons of these, which is just, basically what Steve Jobs and Johnny Ive put together, just a little better chips each year, a little better cameras, which is all, by the way, a lot of the technology is produced by other companies, not by Apple. As long as they can do that, they're set here in the short term meaning the next several years. But for the long term, it's another blow to them. And it once again shows that you cannot compete with Tesla on the tech side. Company after company after company are realizing you can't keep up with Tesla. You can't do it. Rivian is realizing it. Lucid has realized it, right? NIO's realized it. Apple's now realizing it, and there's a lot of other companies that wanted to compete with Tesla, and they realized they just don't have the teams. One of the things I said that's always a huge competitive advantage for Tesla is they got the best engineers. I've known a lot of these folks over the years because of my Tesla coverage of the stock going back. I've covered the stock for 5-6 years. I've gotten to know some of them inside my private stock group, have conversations with these folks, and man, they are so freaking the highest tier. And you can't compete with these guys. And so even Apple's now realizing that. And, so another huge win now takes one less potential competitive threat right out of the market. And maybe, just maybe, here's a little conspiracy theory. Maybe Elon Musk, maybe he knew Apple had these ambitions, right? Elon Musk knows everything that's going on inside all these tech companies, right? He's connected with everybody that's everybody. Maybe him lowering the price over the past 18 months, maybe that was also a ploy to basically say, Apple, you're not going to stand a chance here. Maybe that was bigger. A lot of people think he was just cutting price. He's just been cutting price to move volume. Well, if you look at the math around it, it hasn't really helped nearly as much move volume. It just hasn't. Maybe a little bit here and there, but it hasn't really added up. So maybe his price cuts here, maybe this was to basically eliminate Apple and say, you want to come into this market, you better be ready to just have, insanely low margins because you're not going to produce better margins than us. And you're going to have to be in just a very tough place in terms of your margins for years. So maybe this was, maybe that's a little conspiracy theory out there that this last 18 months of lowering price, Apple said, we can't freaking do this. China's ridiculously competitive. The United States market, no one wants an EV unless it's a Tesla, right? People want a Tesla. They don't want an EV. If they want an EV, you would see all these other auto manufacturers putting up phenomenal numbers, right? And look at everybody else that produces EVs. Their numbers are horrible. Rivian's guidance was pathetic. Lucid's guidance beyond pathetic. 9,000 units? For all of 2024, Tesla produces they'll probably produce about 6,000 units a day. And Lucid's talking about 9,000 total. And then you look at what Ford's done and how much they've had to cut price. You look at what GM's at. It's clear you can't compete with Tesla. And I think even Apple and Tim Cook realize you can't compete with these guys. And so me as a Tesla shareholder, I'm nothing but pleased by this news overall. Apple's always good from a marketing front. They bring a lot of awareness to a category. But at the end of the day, I like it when a big dog like Apple throws in the cards and says, we got to fold our hand. We can't do this. We can't do this. I just, in my opinion, puts Tesla even on another level here, folks, okay? And if people weren't believers of Tesla's team here and what they got going on the tech side, I think this is more proof in the pudding. And I think it's also evidence that Apple says we cannot solve self-driving vehicles. We can't do it. Think about that for a moment. Tired of people whining about all that matters is the Magnificent Seven.
Here at Post 9, it's good to see you, AP.
Thanks, Trev.
Steve's got a great point. And then this decoupling of equities from the rate environment, is that all because of Mag 7 or something else?
I was just sitting there watching, thinking, I kind of am partially responsible years ago for starting this garbage of good news is bad and bad news is good when I used to work at Morgan Stanley. And I was sitting here thinking, you know what it is? It's just good news is good news and bad is bad. That's where we are now. You get bad economic news, I think the market's going to go lower. I think if you get good news, we continue to do well. And it's no longer just all about, expectations for interest rates a year from now. We're in this pocket where if we get continued decent economic news, we don't think things are falling off a cliff, I think equities look pretty good. So we're in the normal, God forbid, good news is good for markets and bad is bad. Maybe that's where we are. I know that what doesn't work is good economic news is bad for markets for a long time. I get how you get a little hawkish, you get worried. That's always a 2-day thing. So that's kind of where my head was watching that. Is maybe we're just good news is going to be pretty good.
So does that require kind of a decoupling of the way we think about interest rates and the interplay and what it means for corporate America? Because obviously with higher for longer interest rates, that means higher financing costs and, it affects discounted cash flows out into the future. So, with cost of capital where it is, how is it that the market can kind of reverse its thinking on that?
Good high-level question.
Two thoughts. One is, I think that thinking is very recent, like the last year or two. Back 100 years ago when I was in school, I thought what I learned is if the economy's good, the 10-year yield backs up and the stock market goes up because they're both representative of things improving. That's actually really where the baseline is. We've gotten this whole like Fed-induced, all that matters is the Fed thing that's kind of made your point where everyone's mind is the last couple of years. So I think the second thing is I focus on the biggest 500 companies or so, in the U.S. And this will be dismissive. I'm sure I'll get some commentary, but basically the S&P 500 companies don't go bankrupt. Okay, they both basically, one or two every few. So they have high quality balance sheets. The cost of capital, which you talked about, is really more for profitless businesses in biotech, refinancing the capital markets activity. It's not really when you look at the biggest 100 companies that continue to do well. So that's kind of my two thoughts on what you said. And then,
let me push back here. The problem is many of these S&P 500 companies do have massive debt loads, right? And so as you need to do, obviously, some sort of refinancing or anything in the debt markets, your interest rates are just substantially more than they were, 2 years ago, let's say, for instance, right? And so at the end of the day, your interest expense goes up dramatically. And I've seen that for a lot of the debt-ridden companies, their interest expense has gone up epically over where it was a year ago or 2 years ago, right? And if you don't have a big cash balance to offset that with interest income, it hurts your profitability at the end of the day. It hurts your net income substantially, right? And I've seen that for a lot of these big debt load companies, and there's a lot of them in that S&P 500. And so it definitely weighs on these companies' earnings over time.
What I thought was interesting is just the magnitude of the moves you talked about on earnings, right? Where, how much these stocks are up. You didn't mention, I think, Melly, that thing's down. It's like there's just big moves going on underneath. So I'm kind of tired of people whining about all that matters is the Mag 7 and that's all I have to get right. No, there's tons of alpha stuff going on, as you point out in some of the names you went through. So there's some stuff going on.
But are you saying that the Russell is outside of your realm of interest?
No, it's just that it doesn't work unless you think gross margins are going up for the average company. To say that you like small caps means you're very bullish. You think that it's a risk-on trade. That happened in November. Why? Because financial conditions eased, and that's all that mattered. Now, for you to believe that we have this broadening rallying, everything's awesome, you're bullish, and you think margins are going up for lots of companies, and their estimates are going up more than Mag 7.
But you've written recently that you think margins arguably have bottomed.
I think they have bottomed, and that's why I'm bullish on a lot of things, but I think you have to own the Mag 7. I don't see how you can take the risk of being underweight that group unless you're wildly bullish.
What about just the broader macro conditions here? I mean, you've basically said a soft landing kind of coming into view here. Is that more dependent, perhaps, than what we're getting out of the Fed with regard to maybe preemptive rate cuts or something like that?
It's funny. Like if you go to Trivariate's website, you search on Powell, it says 0 search results. Why? Because I have no clue. Okay, I've worked with really smart people at big firms, and they're not good at it either. It's just really hard and unknowable. And so I think that's why I focus more on the corporate earnings and the big companies. And I look at the big names and their numbers, the biggest 20 U.S. equities, their earnings numbers are up a lot. And that's why I want exposure to it. But, the answer to your question is I think it's mixed. Okay, I think economic activity looks like it could be bottoming. LEIs are maybe a little bit better. But the consumer's slowing, and it's in good but declining position. And I think maybe industrial activity could be bottoming. When I piece it all together, whatever the couple hundred variables we look at, it's okay but declining. That's how I'd summarize the economy. But corporate earnings can be a lot better than the economy for all the reasons we talked about. Those companies that you go through, they have power, they have pricing power, they have cost controls, they have moats on that technology, they grow their net income 15% plus a year pretty consistently. So the reason I'm always bullish on U.S. equities, and I don't like when people say they like EM or they like bonds, is get me exposure to the best 20 U.S. equities. Get me something better than that 15% per year growth. And then so that's been more or less the broken record for the last 10 plus years, I guess. Yeah.
So let me share something very important before we get in this last video, okay? So in regards to the next move for the market overall, okay? Here's how it works out. If we're in a true bull market right now, here's how it's going to work out, okay? So at first, you get a lot of the big dog companies obviously doing very, very well, which would be like the Mag 7, for instance, and a lot of the large caps, right? And those stocks have done tremendous over this past, let's call it 12 to 18 months. Now at this point in time, okay? If we're in a true bull market, the next move for this next 12 months will be small caps. The Russell 2000 would go on a pretty insane, epic run over the next 12 months. Then what would happen is the smalls would start to slow after that, and then you would have one last kind of move upward for a lot of the big dogs, and then after that last big move for the big dogs, then you have the next bear cycle, okay? So if we're in a real bull market, we have still another 1 to 2 years of this bull market to play out before you get the next big bear cycle. If we're in like this is legit, right? Because we still got to get a 12-month roll for the smalls. Then after that, you have to get another roll for the big dogs. And then after that, you have let's just call it a market that gets a little ugly there, right? Which puts us all the way out until like around 2026. So that's if we're in a real bull market, right? And a lot of that depends on if the economy holds up over the next, let's call it 1 to 2 years. And if the economy holds for the next 2 years, then we're rolling, baby. Okay? All right, guys, let's get into this.
You keep using 95 as an analog for where we are roughly right now. Can you talk about that?
And not 99.
Right.
And I think that's the important thing is that it's because of the monetization. The spending that's happened with the godfather of AI, Jensen, NVIDIA, that's just the start. Now the second, third, fourth derivatives, we think for every $1 of spend on a GPU, there can now be a multiplier of $10, $12. You think about that multiplier into software, into chips, I believe the AI party has already begun.
Are you going to ignore any kind of inventory corrections, even if they're short and shallow on a quarterly basis? You're just going to ride this for the next 5 years?
Look, and I'll be in Asia in the next 2 weeks, so we're going to have to navigate around it. And you have some supply issues, regulatory, but ultimately, when we look to where this is all going, I mean, I'd say we're in the dugout to first inning.
Not even the batter's box.
Not even the batter's box relative to the overall AI revolution. And even though we started here from the godfather of AI, Jensen, it's now, you see what's happened in Redmond. You look what's happening at Google. Look at Amazon. You look at names like MongoDB, Palantir. Now investors are focused on, okay, who's the second, third, fourth derivative, which is why we believe that this tech bull market has a lot of legs going to 24, 25.
Can you explain the multiplier effect for our viewers and exactly where you see that filtering, and also kind of the time frame by which it filters through? Because that's important here, given just the, as you mentioned, we're in the batter's box of monetization. So how soon can you really see that multiplier effect trickle into earnings?
That's why Kramer talks about Taylor Swift moment for tech. And I agree as a Taylor Swift moment, because what's happened, you look at that dollar for GPUs. Now, Copilot. You got to go to Microsoft, build out the foundation. What does that do to what's happened? Redmond, we saw that in the earnings. Then the use cases. How do you actually deploy in the use cases? Mongo, Palantir, Snowflake, data. You start to go down the list. The multiplier for every $1 of GPU, now it's the software ecosystem. And this is really going to bring a tidal wave to spend on software for, I'd say, infrastructure. And then you look at services. And I think that's why a lot of these stocks, people will talk about it's a bubble, 99. I disagree. Some of that covered tech stocks back then can't even compare relative to valuations, balance sheets, and monetization. And that's what.
So I love to listen to conference calls of even stocks I don't own. And the reason I'll do that is I pick up information that essentially, I just wouldn't have otherwise, right? And so Snowflake's a stock I don't personally own, but a lot of times I'll listen to their conference calls. And so this was probably 6 months ago or so. I was listening to a Snowflake conference call, and the CEO and I believe it was COO was on the conference call. And they were they were basically asked, like, when do we, NVIDIA's seeing all this, ramp up in demand in terms of the hardware side. When do we see it on the software side? And the executive said, listen, you're going to see that more in 2024 and beyond, right? And so when it comes to the AI demand more on the not chip-related side, let's just call it that, it's really a 2024 and beyond story. And so for those companies like the Palantirs, or if you want to throw the Snowflakes, and I don't cover the MongoDB company, but if you want to talk about those companies, it's really 2024 and beyond is when you really start to see the ramp up in the spend for those specific companies, okay? So just something important to keep in mind.
Monetization's happening, and we believe the AI revolution, it's a get out the popcorn moment. I'm not saying you're not going to have some little speed bumps here and there relative to where we see this year.
More broadly, within Mag 7, there's some discussion today about Tesla, Apple underperformance within that group. How are you thinking about that?
Well, I think for Apple, we're just about to get that renaissance of growth. I mean, I talk about iPhones is just the tip relative to on the services side. And we believe the AI app store that Cook will talk about and unveil, WWDC, as well as AI in terms of exclusive LLMs in iPhone 16, this is now going to be the renaissance of growth at Apple from what an AI perspective. And also iPhones, we continue to believe, not roses and champagne in Beijing, but we're starting to see a stabilization post the new year. Tesla, it's definitely a white knuckle period. But we continue to believe on the other side of that is the growth, is the AI piece, is demand, where I still believe right now the street, I think underestimate what demand could be.
So for Apple specific, there's something big about to happen, and it has nothing to do with AI, okay? The big thing that's about to happen for Apple is in about, we can call it 7, 8 months from now, Apple's going to show off their next iPhone. The big thing is it's supposed to be a bigger iPhone. And so we're likely going to see a super cycle in iPhone next year. If you look back, every single time Apple ever makes a bigger iPhone, it's just always crazy demand. I can't tell you why. Maybe it's just people really love the newer, bigger iPhones. But from my understanding, it's going to be bigger versions. And I'm telling you, it's going to freaking sell. And so that's the big thing for Apple for next year, obviously. You're not going to really see it reflected in, obviously, the numbers they report this year, because it's not going to be in the market, right? But in terms of the numbers next year, you're going to really see it in quite a substantial way. And I think that's good for them. This AI stuff, their new product they have out in the market, in the Vision Pro product, right? A lot of talk and things like that. I've heard of people already returning those. And, I told you my opinion on that. I don't need to go back into that. But nonetheless, if it's a super cycle for iPhone next year, it's going to be very good for Apple stock.